Assalamu alaikum and very good morning. Munawwar Hamid Mangalwala is here from Pakistan. So today we are going to discuss about Clear. C-L-E-A-R. This Clear is a mnemonic. What do I mean? When I open this one word, Clear, you will get 5 words. How many words you will get? You will get 5 terms of accounting. C-L-E-A-R. C for capital, L for liabilities, E for expenses, A for assets and R for revenue. So by the passage of time, I will develop my students in such a way that from base I will take them to the higher level of accountancy. I mean, whatever I know, I am just imparting knowledge for the benefit of the students all over the world, as well as some of my friends can also get the benefit. And I am very much here to learn from you. And my email address is accountsteacher@gmail.com. So today we will discuss about Clear. C for capital. Capital means investment. Capital are of 2 types. Number 1, capital in cash and capital in kind. Remember, in accounting we have different concepts. Among those concepts, there is one concept which is called business entity concept. Business entity concept means owner of the business is separate from the business. If I put some money in my business, it means I am owner of the business, and the money which I am investing, which I am putting into the business, that money is business money. Now that is not my money. So business entity concept says owner and business are 2 different identification, 2 different identities. So capital means investment. Capital is invested sometime in cash, most of the time in cash, and sometime in kind. In kind means except cash. For example, me and my friend Anis Ali bringing a car in the business. So I invested cash, Anis Ali invested cash, and Mr. Anis Ali is bringing his car. So now we are the partners. Further, after capital we have liabilities. So before I go to the liability, one more thing about capital. When you put cash into the business, it means you are investing, and sometimes you take out cash from the business for personal use. Sometimes you take out cash for personal use from the business. Business does not like this thing, but you need the money, and you are not taking that money as a salary, but you are taking that money as drawing. Drawing is a contra capital account. It reduces the capital of the business. We are discussing at the moment capital in relation to sole trader. When we discuss capital in terms of partnership, there are also capitals of the partner, but there are 2 more accounts. One more account, and that is called, if there are 2 partners, 2 more account of course, and these accounts are called current accounts or fluctuating capital. It means if I am bringing some cash at the start of the year and you are also bringing some cash at the start of the year, that is the capital. And then after a year, some salary I am taking, some commission I am taking, some share of the profit you and me we are taking. So those amount will be transferred to the current account of the partners, not in the capital account, because of generally we keep the capital fixed. In terms of company accountancy, when we are discussing about company accounts, we should know that in company accounts capital is not there, there is share capital. So share capital means when people are investing in your company. Fine. So when we discuss the topics of partnership and company accounts, after maybe months or weeks, so there we will discuss about company accounts and partnership. Here at the moment we are discussing simple idea of capital. in relation to sole trader. C. Capital. L. Liabilities. Liabilities means loan. Loan is an obligation. Whenever I take a loan, that's a burden on me. Whenever I repay the loan, my loan is going down. And whenever you repay the loan, you do not say that you are paying the loan, you say you repay the loan. Another thing, liabilities are of two types. Number one, current liabilities, and number two, long-term liabilities. Current liabilities means I have taken some money for personal use, okay, that will be that I am not going to record in the business books, but I am taking some money for the business use. Yes, I am the responsible person because of my liability is unlimited. So I am taking the loan for the business use. I need to record in the books of business. That's short-term liabilities, accounts payable, bills payable, fee payable, commission payable, salaries payable. These all payables, accrued, owing, unpaid are different names. I am supposed to pay in 1 year time. Long-term liabilities are what? A liability for a long period of time, generally having a huge amount. In company accounts, those liabilities are also known as debentures. The companies issue debentures. This is basically a loan. Sometimes you make the portion of the liability. I have taken a liability for 5 years, but I will repay first year some part of that specific obligation. So it means from fixed liabilities, some amount is being transferred to the current portion of the liability, and then we are going to repay. CLE. E for expenses. When we discuss about expenses, we should know that in accounting there is a concept which is called accrual basis concept. Accrual concept. You must remember that. What is accrual concept? Remember, expenses are not related to cash. Expenses are related to services. When you receive the service, you need to record the expense. No matter you paid now or you did not make the payment now, but that is your expense. This is the month of June. For example, I made a payment of 5,000 for some of my bill. Now there are three things. Number one, I received the services in the month of June and I paid the money in the month of June. This is expense. But suppose there was a liability on me which of the last month of May, and I am making the payment now in June. It means this is the repayment of liability. This is not the current expense of June. It is also possible that I am going to make a payment for July. I am making a payment in advance. So when I am making the payment, I am making the payment in the month of June. So that is not the expense of June. So what did we learn? We learned expenses are related to services or the product, but not cash. You get the point? So that's very important. Expenses, again, we can discuss. When we look at the expenses, we can look from 2 points of view. Number one, revenue expenditure and capital expenditures. Revenue expenditure means day-to-day expenses. Like I make the payment for electricity bill, revenue expenditure. For salaries, revenue expenditure. But when you are going to make the payment for buying non-current assets, like you purchase a car, you purchase machinery, plant, property, plant, equipment. So these all are capital expenditure. We have three financial statements. Initially I am introducing three. Income statement, statement of performance. Balance sheet, statement of financial position, and statement of cash flow. So we should remember that whenever we are recording revenue expenditure, we need to record in income statement, statement of performance. But when we record capital expenditure, we record in the balance sheet. You get the point? CLEA. A for assets. Assets are economic resources. Non-current assets, property, plant, equipment. fixed assets, long-term assets. These assets generate revenue for the organization. What do these assets do? These assets generate revenue for the organization. These are non-current assets. We have International Accounting Standards. International Accounting Standard number 16. It tells you the detail of these types of assets as well as related concepts. Whenever you are using an asset, you are utilizing the services of asset, you need to record an expense, and that expense is called depreciation expense. When we will discuss about depreciation topic of depreciation, then I will discuss there inshallah in detail. So we come back. So after assets, before I go to the next point, we should know there are different types of assets: non-current assets, current assets. What are the current assets? Current assets are like just a minute, there's a phone I'm just receiving. Qadi bhai, अस्सलाम वालेकुम. ये हॉल नंबर 1 में. जी जी, आप किस मेन गेट पे आए. मेन गेट से किसी को पूछें कि वेयर इज गेट नंबर 1. जी, हॉल नंबर 1 में आ जाएं. आप ढूंढेंगे तो आपको मिलेगा. जी वहीं पर है. थैंक यू. आई एम सॉरी, देयर वाज अ कॉलीग ऑफ माइन and today we have expo, education expo at Expo Center Karachi. So we are representing our university, KEET University, Karachi Institute of Economics and Technology. So there was a phone from one of my colleagues. Anyways, we come back. So basically what we are discussing about assets. We have current assets. Current assets are called liquid assets. What are these? Cash, bank, prepayments, accounts receivable. Short term, these are stocks, I mean inventory, merchandise. These assets are converted from 1 year, I mean to next year in another shape. Like you purchase inventory and then you are going to sell inventory. When you sold the inventory, now this inventory is transferred or converted into cash. You get the point? We have financial assets like investment. We have fictitious assets, assets which you can touch, property, plant, equipment. You can touch these assets. We have fictitious assets. Tangible, I told you. Intangible assets, assets which you cannot touch, like account receivable. You cannot touch a debtor like that, of course. We have intangible assets like goodwill, patents, rights, franchises. These are non-current assets. These are fictitious assets. Then we have biological assets, cattle, plant. Okay, cattle, you can say people have cattle like cows and goats, all these things. Okay, so assets are economic resources, CLEA, and then revenue. Again, revenue means income, sales. Revenue are also recorded on the basis of accrual system. But revenue, we should know that revenue, when we talk about revenue, we consider the concept of realization as well. Whenever we record the revenue and goods are transferred, risk and reward are transferred to the customer from us. Like I have a pen, or I have a phone, I'm very happy with this phone. I'm taking the risk and reward of this phone. But I'm selling this phone if this is my inventory. So then my revenue will increase. Remember, sale means sale of goods which you purchase for resale. So basically this was all about revenue. Is also called income. So when we record the income, we should understand that the money which I received, for example, I received the money in the month of June, and that money was due on my customer in the month of May. I sold in the month of May some product, some goods, some inventory. So that is not the income of this month. This is the income of last month. You get the point? For example, I received the money in advance for the month of July, this month. This is not the income of June. income of June is only in one condition, when I provided the services in the month of June, when the goods are transferred in the month of June or services are transferred in the month of June from me and I receive the money, that's my income. You get the point? So today basically we discuss about CLEAR, CLEAR, capital, liabilities, expenses, asset and liability. Thank you very much. Assalamu alaikum. Pakistan Zindabad.